Hello and welcome to Sovereign Financials, financial education for everyone. Alright guys, so today is going to be the first part in a series of how to invest in stocks, and today we're specifically going to be looking at the PE ratio. Using the PE ratio is one of the best ways to start finding value stocks. The idea behind value investing is making investments in companies where the price of the stock is less than or equal to the value of the stock. Value investing is how people like Warren Buffett and Charlie Munger have made billions of dollars. Now you might ask, what is the difference between price, which is also called cost, and value? The difference is quite significant. However, most average investors do not know what the terms mean. Cost is the price of an individual stock. This is the price that is listed on your favorite news channel or on websites such as Morningstar.com, MarketWatch.com, or Google Finance. Now, finding the price of a stock is quite easy. However, determining the value of a stock is a very different story. Value is a much more complex idea. Value means what the stock is actually worth, and you're not going to find this number published anywhere, as value can be calculated in many different ways, and the results are going to be different between different investors. A stock's price and its value can be very different. And when the stock costs less than its value, which means that it costs less than what it's actually worth, that would be a good investment for the value investor. Alright, so let's start with an example that'll be more familiar to most people. In the first example, this house here is priced at $500,000 and has 2,000 square feet. Now, all the other houses in the area that also have 2,000 square feet are priced at $250,000, and there's no other significant difference between the different houses. That would mean that this house priced at $500,000 costs more than the value of the home, since we can obtain an equal house for $250,000 in the same area. This means that the price of the house we want to purchase is greater than the value of the house, and we should not purchase it. It would therefore be a bad investment. The exact opposite could be true if this house now cost $100,000, while all of the other equal houses in the area cost $250,000. This would mean that the price is now less than the value of the home, and it would be a great value investment. Now, price and value differ when the stock market has become emotional or a characteristic of the company has gone unnoticed by the majority. In our first example here, we have an average price market where the price people are willing to pay for an asset is equivalent to the value of the asset. Our second example is called an overpriced market. Sometimes people will call this an overvalued market, but don't let their change in words confuse you. In this situation, the asset is overpriced compared to the value of the investment they are making. This happens when people get very excited about a company and they think it will make much more money in the future than they are currently making, and oftentimes they become too optimistic in their estimations. Our third example here is an underpriced market, also sometimes called an undervalued market, but the meaning is exactly the same. In this situation, people believe the company will perform much worse in the future than how it's currently doing. These people are usually over-pessimistic. Now, a good investor will have a way to determine what the investment is actually worth, which is known as its value, and then compare the current price of that investment to the value that we calculated, and then we can determine if it is fairly priced, or if it's overpriced, or if it's underpriced, and this will help us to determine if it's a good investment for us or not. In this specific lecture, we'll be going over the PE ratio to determine the value of various stock investments. Now let me ask you a question. If you owned a company and it lost money every single month and never makes any profit, what would the value of the company be? The answer to that question is $0, or technically a negative number since it takes money out of your pocket every single month. On the flip side, if you owned a company and that company made $10,000 a month, what would the value of that company be? This is a much more difficult question, but at least you know that it has to be a positive number since it makes you money every month. We'll work on figuring out how to assign value to this income, which is called earnings, when it's made by a business. Okay, so let's start by defining a few terms. The first term is earnings. Earnings is the profit that a company made, and it's usually spoken about in regards to the money they made in the entire past 12 months. However, it is reported on a quarterly basis. In this part, we'll be discussing earnings in regards to how much money they made over the entire past 12 months. This is essentially a measure of how profitable the company was in the past 1 year. Now, stocks are shares of a company, and by owning shares of a company, you are a partial owner of the company, specifically a partial owner of their profits. Let's take this grocery store for example here. It has 4 shares, and let's say the earnings over the past 12 months was $4. That means if you take those $4 and you divide it by the total number of shares, which is 4, the earnings per share of stock is $1. Now let's get on to the PE ratio. Using the stock from our previous example, the company made a total of $4 in the past 12 months, and it had a total of 4 shares of stock, giving us an earnings per share of $1. This earnings per share of $1 is the basis for value of this company. Now, if we look at the price of the stock on the market by going to marketwatch.com or morningstar.com, let's say it costs $10 per share. Since the PE ratio is the price to earnings ratio, we will then take the price of $10 and divide it by the earnings per share, which is $1. So 10 divided by 1 gives us a PE ratio of 10. So what is a fair PE ratio? According to Warren Buffett and Benjamin Graham, who wrote the book The Intelligent Investor and taught Warren Buffett how to be a good investor, a PE ratio of less than 10 would be considered to be underpriced and would make for a good value investment. Now, a PE ratio of 15, that's a fairly priced stock and is still a good purchase for a value investor. However, when you start getting to PE ratios of 20 or more, that starts falling into the overpriced range, and a value investor would not typically buy these kinds of stocks. And last but not least, a PE ratio of greater than 30 indicates it's an extreme bubble, and it would probably not be a good idea to invest in that type of stock. Alright, so let's take a real-world example of what this might look like. We're going to go to marketwatch.com, as you can see up here in the top of the bar, and we're going to look at a couple stocks. So the first stock we're going to look at is going to be Amazon. So we're going to click on Amazon down here. And what's nice about websites like MarketWatch or Morningstar or even Google Finance is you don't have to do any of these calculations yourself. The website's already put them together for you. So if you can see right down here, this right here says earnings per share. Let's zoom in on this a little bit. Make this a little bit easier to see. So this says earnings per share right here, and it's $12.60. Now, the price of of one share of Amazon stock is $2,000. So the way I want you to look at it is this, is you're paying $2,000 for a claim on earnings per share of $12.60. So you're paying $2,000 to have a right to $12.60 of their earnings. What's nice is it already calculates a PE ratio for you, which is 155. Now these can vary a little bit. You would just take the price of the stock, divide it by the earnings per share, and you should get the PE ratio. However, these PE ratios are calculated on a quarterly basis, so these things don't always match up perfectly, but they come pretty close. So a PE ratio of 155, according to Warren Buffett, who learned from Benjamin Graham, would be considered to be an excessive bubble. There are a couple reasons why Amazon stock is as high, is because people think it'll take over the world, in which case if it does take over the world, people are assuming that the earnings per share would go up, and the price of stock might not go up as much, and therefore the PE ratio would come down upon quote taking over the entire world. With that being said, there'd be it's kind of a gamble or some speculation, because as Amazon gets too big, there'd be a lot of monopoly laws and antitrust laws that would come in place. But this is 155 is people being over optimistic. So this Amazon, in my opinion, right now would be overpriced, as you're paying $2,000 for just a claim on $12. All right, let's take a look at another stock. Let's look at Apple. right? Apple has a pretty big market share. Lots of people end up using Apple phones, the Mac computers, etc. So Apple has an earnings per share of $11, which is pretty close to Amazon. So per share, Amazon and Apple are almost making the exact same amount of money per share out there. Now, if you look at what the Apple stock cost, is $226, meaning that you're paying $226 for a claim on $11, right? And that gives you a PE ratio of 20.23. The 0.23 doesn't really matter too much, but it gives you a PE ratio of 20. So this is much, for how much earnings per share you're getting, this PE ratio is a much better deal. So they both have large market shares. Apple's potentially getting bigger, Amazon might get bigger, but in terms of how much you're having to pay, the price, $226, for the value, which is the earnings per share, Apple's a much better deal than Amazon would be in that regards. All right, and let's take a look at one more here. Let's go with AT&T. Right, nothing exciting about AT&T, for better or for worse. For an investor, it might be a good thing because it's kind of overlooked. So AT&T has an earnings per share of $5, and the price of that is $32. So you're paying $32 is the price for a claim on $5 of value. This gives you a PE ratio of 6, right? So at PE ratio 6 being less than 10 would mean that this is an underpriced stock. It means that the AT&T shares should be selling for more than $32 per share based on how much value they're offering, which is $5. So this would be an underpriced stock. Also, sometimes people will call it undervalued, which is a little bit incorrect nomenclature. But with a PE ratio of 6, this would be a better buy than either Apple or Amazon. Now, if all this seems too simple, that's because it's a very simple way of looking at things. This is a great introduction and a great way to start looking at stocks, but there are multiple other things you have to take a look into, including like what kind of dividend they're paying you, how much debt the company has can greatly change this, price to book value, and growth opportunities. And we'll talk about these in future videos. So thanks for hanging around, guys. Thanks for viewing the video. If you can open this link in YouTube, if you're watching it in Facebook, and in the bottom right hand corner of the screen, down here, if you see my arrow kind of come down here, hit the subscribe button, like, share it with your friends, be greatly appreciated. All right, and until next time, thanks guys.